I want you to picture a specific scene. It plays out every single morning all over the world, probably right in your neighborhood. You have this guy, let's call him the prepared trader.
Oh, we all know this guy.
Right. On paper, this guy is the absolute definition of success. He's got, the fastest fiber optic internet. He's sitting in a $3,000 ergonomic chair. He's staring at a bank of monitors that looks like, I don't know, NASA mission control.
The ultimate command center.
Exactly. And he is not winning it. He hasn't just rolled out of bed. He has spent 6 months back testing a strategy. He has the data, he knows his entry points, his exits, his risk ratios. I mean, he is ready.
He's done the homework. He has all the theoretical knowledge you could possibly ask for.
Right. So the market opens, bells ring, charts start flashing, he gets a signal. It is the exact setup he's been waiting for, matches his plan perfectly. But then the market ticks against him, just, 2 or 3 ticks, and suddenly he freezes.
Yeah, the paralysis. I was actually watching a new trader the other day, and this exact thing happened. He had everything. Best software, 3 monitors, the back-tested strategy.
Yep.
But the moment the market moved against him by just a few ticks, I literally saw him freeze.
It's wild, isn't it? Because it wasn't a lack of information that paralyzed him.
No, not at all. It was the way his mind was processing that information.
No, I think I know exactly how he feels. It's that internal tug of war. You see the signal, you know what the rules say, but there's this voice in the back of your head asking, what if this is the one that fails?
Yes. And after a couple of losses, that voice becomes an absolute shout.
You start looking for extra confirmation, and by the time you feel safe enough to enter, the move is already half over. It's exhausting.
It is exhausting because you're trying to do something the market was never designed to let you do. You're trying to be right.
Which brings us to the core of our deep dive today. We're looking at Trading in the Zone by Mark Douglas, and this isn't a book about moving averages or balance sheets.
No, it's a psychological guide. It's about bridging that gap between analysis and execution.
Right. Because most people come into this environment from worlds where being right is rewarded. School, careers, social structures. You study hard, you get an A, you follow the surgical procedure, the patient lives.
But the market doesn't care about your need for correctness. In fact, Douglas argues that the more you try to be right, the more the market will punish you. The skills that lead to success in society are the exact skills that lead to failure in the market.
That feels so counterintuitive, though. I mean, if I'm not trying to be right, what am I even doing here? Isn't the whole point of technical analysis to predict what's going to happen next?
That right there is the fundamental psychological gap we have to close today. Analysis is just a tool to identify an edge, and we have to be very careful with how we define that word.
Because most people think an edge means they know a secret.
Exactly. They think an edge is a crystal ball. But it's not. It's simply an indication that there is a higher mathematical probability of one thing happening over another. That's it. It's a numbers game. But our brains are wired to treat it like a battle of wits.
So when I see, a perfect head and shoulders pattern on my chart or a specific retracement, I shouldn't expect it to work.
You should expect that something will happen, but you must remain completely neutral about what that something is.
Neutral. That's a tough word to swallow when your own money is on the line.
It is, but think about a casino. They don't know if the next person walking up to the blackjack table is going to hit a jackpot or lose their shirt. On a micro level, the individual hand, the outcome, is totally random.
Because the dealer could bust or the player could get lucky.
Right. But on a macro level, over 1,000 hands, the casino's edge is a mathematical certainty. They stay calm because they've accepted the randomness of the individual event to gain the consistency of the collective.
I like the casino analogy, but it's just harder when it's my own capital on the table. When the casino loses a hand, the pit boss doesn't feel like the market is against them. But when I lose 3 trades in a row, I start feeling like the market is personally hunting my stop losses.
Oh, everyone feels that way at first.
How do I stop taking the market's movement so personally?
You have to realize that the market is neutral. It's just a stream of data, upticks and downticks. It doesn't know you exist.
It doesn't know about my mortgage or my ego.
Exactly. The pain you feel isn't coming from the market. It's coming from the way you interpret that data. If you have a rigid expectation that the market must go up because your analysis said so, then every downtick feels like a personal betrayal.
So the fear comes from the expectation.
Exactly. Fear is your mind's way of trying to protect you from a perceived threat. But in trading, the threat is usually just information that contradicts what you want to happen.
And when you're afraid, your vision literally narrows.
It does. You stop seeing what the market is actually doing. and start seeing only what you're afraid of. You'll ignore a clear trend change because you're so focused on the pain of being wrong.
I've definitely been there. I'll stay in a losing trade, hoping it turns around, while the charts are absolutely screaming at me that the trend has reversed. I'm literally blind to the new data because I haven't accepted the risk of the original trade.
And that's the key phrase right there, accepting the risk. Most traders think that putting on a trade means they've accepted the risk.
Because they put a stop-loss order in the system.
Right, but they haven't actually accepted it. They've just taken a chance. Truly accepting the risk means you are at total peace with the outcome, even if it's a loss.
Douglas talks about a physical reaction to this, doesn't he?
He calls it the clench test.
Yeah.
If you're still feeling that clench in your stomach or your heart rate rises when price nears your stop, you haven't accepted the risk. You're still arguing with reality.
You're silently pleading with the market to turn around so you don't have to be wrong.
Exactly. And when risk is truly accepted, the market cannot generate painful information. The pain only comes from your resistance to what is.
There's a story in the book that I think perfectly illustrates how this fear gets wired into us. It's the story of the boy and the dog. I'd love for you to walk us through that because it really clicked for me.
It's a brilliant analogy. So imagine a young boy who has never seen a dog before. He has no past data. He sees a dog, he's curious, so he reaches out to pet it. But this particular dog is mean. It snarls and bites him.
Right, so his first experience is physical pain and trauma.
High impact trauma. Now, fast forward a bit. The boy walks down the street and sees a different dog. This one is a golden retriever, wagging its tail, totally friendly. What does the boy do?
He probably screams and runs away.
Yes, but why? The environment, the golden retriever, is offering an opportunity for play, but the boy cannot perceive that opportunity. His mind has created a hardwired association. Dog equals pain.
So he's projecting his past memory onto the present reality?
Exactly. He cannot see a friendly dog. He only perceives a threat. And traders do this with markets every single day.
So if I lose money on a certain setup on Tuesday and it really hurts my account,
then on Thursday, when you see that exact same perfect setup, the market is offering you an opportunity. But you don't see opportunity. You see the teeth of the dog that bit you on Tuesday.
and that's why you hesitate, you flinch, you miss the entry.
You freeze. Your past losses cause you to perceive the now moment as a threat, completely blinding you to the edge you've worked so hard to find.
How do I get to that state of peace then? Especially when every moment in the market feels so entirely different from the last.
By embracing the absolute uniqueness of the now.
Yeah.
Every moment in the market is actually a unique occurrence. Even if the chart pattern looks exactly like one from yesterday, the combination of traders, the people actually moving the price, is different.
This is what Douglas calls the one trader rule, right?
Yes. It takes only one trader somewhere in the world to negate your edge or change the price. One guy in London deciding to liquidate a position can blow up your perfect pattern.
Which is terrifying at first glance.
It is, until you truly believe that any outcome is possible at any time. Once you accept that, you stop trying to predict the exact outcome of this specific trade, and you start trusting your statistical edge over a series of trades.
So it's about shifting from rigid expectations to flexible ones.
Precisely. The typical novice trader has flexible rules but rigid expectations. They say, oh, I'll move my stop loss, I'll give it more room. That's a flexible rule. But their expectation is rigid. They demand that this trade must work.
And the professional does the exact opposite.
Right. The successful trader has rigid rules for risk management, but completely flexible expectations. Their mindset is, let's see what the market does.
If you don't expect the market to make you a winner on this specific trade, you can't feel betrayed when it doesn't.
You simply execute the edge. You eliminate the potential for betrayal by eliminating the expectation of a guaranteed outcome.
Okay, so logically I understand all of this. I want to think like the casino, I want to accept the risk, but my brain still screams at me when I start losing capital. Is there a practical way to actually move from that student mindset where I'm exhausted and fearful into the casino mindset?
There is. Douglas doesn't just leave you with the philosophy. He suggests a very specific, practical exercise to retrain your brain. It's called the 20 trade exercise.
I remember reading this and thinking it sounded almost too simple, but the psychology behind it is heavy. How does it work?
Step 1, you pick a mechanical system, an edge. It needs to have strictly defined entry and exit variables, no subjective guessing.
So no saying, well, the volume looks a little light, so I'll wait.
None of that. It's binary.
Yeah.
If the signal happens, you take it. Step 2, you commit to taking the next 20 trades without any deviation.
And you have to predefine the risk for every single one of those trades.
Exactly. You know exactly what your risk is before you click the button. But here's the critical part. The goal of this exercise is not to make money on these 20 trades.
Which goes against every instinct a trader has.
I know. But if your goal is to make money, you will evaluate your success on a trade-by-trade basis. The goal of this exercise is purely flawless execution. You execute 20 times without hesitation, without fear, and without breaking your rules.
So even if I lose money over the 20 trades, if I followed the rules perfectly, the exercise is a success.
Yes, because this forces you to think in probabilities. You are forcing your brain to look at a sample size rather than a single trade outcome.
It's like exposure therapy for the market.
That's a great way to put it. If you can take a loss on a trade without feeling that emotional pain, without the clench, you have successfully bridged the psychological gap. You've taught your brain that a loss is just a business expense, not a threat to your survival.
It really all comes back to attitude. Consistency isn't found in a better indicator or upgrading to 4 monitors instead of 3. It is entirely found in the trader's attitude.
The market is just a mirror. It reflects your own internal state right back at you. If you are fearful, you will find a reason to hesitate. If you are confident and accept the risk, you will find the flow.
Before we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought to mull over. Something that builds on what we've talked about today.
I think the coin flip analogy perfectly captures the final state of mind a trader needs to achieve.
Let's lay that out. Imagine you could flip a coin, and you knew for a mathematical fact that heads came up 60% of the time.
And let's say you're betting on heads. You flip the coin, and it comes up tails. Do you feel betrayed?
Do you get mad at the coin?
Do you stare at your thumb and wonder if your flipping technique was flawed? No. You wouldn't care at all. You wouldn't feel any emotional pain because you know the next flip has a 60% chance of being a winner.
You just immediately flip it again.
Exactly. Trading is just flipping that coin. When you truly accept the probabilities, the fear vanishes. You stop trying to conquer the market and you start conquering your own resistance to uncertainty.
Conquering your own resistance, that is incredibly powerful. It changes the entire paradigm from an outward battle to an inward one.
It really is the secret to trading in the zone.
Well, this has been an incredibly eye-opening conversation. To everyone listening, take a hard look at how you react the next time a trade moves against you. Notice the clench. And remember the boy and the dog. Thanks for exploring this with me today.
Anytime. This is a great discussion.
We'll catch you all on the next deep dive. Keep your rules rigid and your expectations flexible.